gentlemen, good day and welcome to the Varroc Engineering Limited Q1 FY2024 earnings conference call hosted by Investec Capital Services. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aditya Jawar. Thank you and over to you, sir.
Yeah, thank you. Good afternoon to you all. From Varroc, we have with us Mr. Tarang Jain, Chairman and Managing Director, Mr. Arjun Jain, Full-Time Director, Mr. Mahendra Kumar, Global CFO, and Mr. Vikas Duggar, Head Investor Relations. We'll start the call with a brief opening remark from the management followed by Q&A session. I would now like to hand over the call to Vikas to take it forward. Over to you, Vikas.
Thank you, Aditya. Thank you, Investec, for hosting the call. Before we ask the chairman for his opening remark, just a small disclaimer that today's discussion may include statement which may constitute forward-looking statement. All statements that address expectation or projection about the future, including but not limited to statement about the strategy for growth, business development, market position, expenditure, and financial results, are forward-looking statements. Forward-looking statements are based on certain assumptions and expectation of future event and involve known and unknown risks, uncertainties, and other factors. So the actual result of performance or achievement may differ materially from those projected in any such forward-looking statement. So no obligation is assumed by the company for the forward-looking statement made during the call. So over to you, sir.
Yeah, thanks, Vikas. Thanks, Aditya. And good evening to everyone and thank you to Investec for hosting the call. To start with speaking about the global economy, it has been more resilient despite monetary tightening by most of the central banks as core inflation remains above the targeted levels. Despite turmoil in the financial markets, we still see a strong labor market and consumption in the developed economies. The Indian economy, on the other hand, has sustained its growth momentum in FY24 so far. Core inflation has started to moderate, which is helping RBI not to increase the interest rate, further supporting the economy. The automobile production in India during Q1 FY24 grew on a year-on-year basis for most of the segments as momentum in economic activity is sustaining. Two-wheeler has grown by 1.3%, passenger vehicles by 7%, three-wheeler registered a strong growth of 24.3%, and commercial vehicles showed a negative growth of 1.5%, as we witnessed some pull ahead in buying activity in Q4 FY23. Due to the OBD2 norms. Generally, Q1 is sluggish and Q4 is the strongest quarter for automotive sales in any financial year, and the same has been witnessed in Q1. On a quarter-on-quarter basis, commercial vehicle has fallen by 12.7%, passenger vehicles by 6.4%, and three-wheeler saw a decline of 2.3%. Only two-wheeler saw a growth of 12.1% on a Q-on-Q basis, as demand was sluggish for two-wheelers both in domestic as well as the export markets in the previous period. In terms of our operations in Q1 FY24, we continued a journey of improving the performance. Our revenue from operations grew by 10% on a year-on-year basis to rupees 17,924 million. Our EBITDA margin was at 10% in the quarter, and it improved on a year-on-year basis by 180 basis points due to improvement in Indian and the overseas operations and certain incentives from government. Sequentially also, the EBITDA margin has gone up by 50 basis points. The reported PBT for the quarter was rupees 652 million, which includes profits from a joint venture of rupees 61.3 million. The ongoing monsoon and festive season will be key to watch out for the automobile sector to continue its momentum. The reduction in FAME 2 subsidy from 1st June 2023 for EV vehicles impacted EV volume sharply, but we are cautiously optimistic about the recovery in volumes in the coming months. Our revenue from supplying to EV players in Q1 FY24 was approximately rupees 651 million, which is 4% of our overall revenue. We continue to build strong order wins in our operations in Q1 FY24. Lifetime revenue from new order wins is rupees 9,552 million in Q1 FY24. Our effort to increase our technical capability was further enhanced in Q1 FY24 as we filed 4 patents in India and 1 overseas. We also have got approval from the board to invest for procuring renewable energy of more than 37 megawatts DC through open access under captive route. This will not only help increase our consumption from renewable sources, but will result in reducing electricity costs from the next year. Finally, we reached a settlement on the final closing adjustments with Plastic Omnium for the four-wheeler lighting businesses, which we sold during October 2023. Based on that, October 2022, based on that, company has received euro 13 million from the escrow amount. After meeting the cost of sale to the extent of euro 5 million, we will be using the balance amount to reduce our net debt levels. Our focus will remain to strengthen our competitiveness in India and globally by developing world-class products and services. We will enhance and leverage our global footprint as we are a global company with strong roots in India. During the current financial year, our businesses will continue to deliver growth and returns while maintaining strong fiscal discipline. With this, now I'll ask MK, our Group CFO, who will walk you through the presentation, which is already uploaded on our website and submitted to the stock exchanges also.
Thank you, Karan. Good evening, everyone. Let me just take you to the highlights slide. This is slide number 4 in the presentation. As our CMD mentioned, the industry growth was some kind of dull during Q1. Despite that, the two-wheeler grew only by 1%, and then the passenger vehicle by 7%. Compared to that, we grew about 10.4%, with a revenue of 1,806 crores approximately. The EBITDA margin was at 10%, up by 1.8% compared to last year, and about 50 basis points more compared to Q4 on sequential basis. Lifetime business one was about 9.6 billion. And then the revenue from EV customers contribute about 4% of our total revenue. Net debt reduced by about 50 crores. We are now at about 1,228 crores. As you may recollect, when the divestment happened, we were at about 1,300 crores. So from that time, we could reduce it by about 72 crores so far. Of course, this is without considering the inflow from the divestment settlement transaction which happened in Q2. So this is as of Q1 end. And the last highlight of the quarter is about the settlement, the divestment process. As we indicated earlier in our declarations to the stock exchanges, there was some kind of a dispute earlier, which we could amicably settle. So that brought in about close to 13 million euro of inflow into the company. Of course, we have some expenses to be met. So net of that, I think close to 6 to 7 million is what we are expecting to see in India, which can reduce our net debt further. So going to the next slide, this is about the overall industry trend. Like what I mentioned earlier, the two-wheeler grew quarter-on-quarter by about 12%. And three-wheeler and other segments actually had a degrowth compared to the previous quarter, which is Q4. But on a year-over-year basis, if you really see, two-wheeler grew by about 1%, 1.3%. Three-wheeler and passenger vehicles also registered good growth. Commercial vehicles had a negative growth. So going forward, the monsoon and festival demand will actually decide the momentum in Q2 and Q3. But we are expecting that should actually continue the current momentum, but we need to keep a watch on that. And then coming to the financials in the next slide, of course, we talked about the revenue growth of 10.4%. In terms of the other financials, we really see EBITDA percentage terms came to 10%, just close to about 180 crores, which is adjusted EBITDA. Another important point this time is the PBT of 3.6%. And you might have also noticed a reduction in interest cost for the first time after many quarters. So that's an interesting point to be noted. Of course, we are expecting that it will come down further in the coming quarters as we continue to repay the debt through cash generation from operations. Then in the next slide, we have the business breakdown, like how we showed earlier. We see a marginal uptick in the Bajaj share of the business to about 42%. Earlier it used to be below 40% because of the increased supplies to the electric vehicles. Then on the new lifetime order win, this is about 955 crores of lifetime win, which we did in Q1 in terms of new orders. And predominantly, if you really see 70%, more than 70% of that is in two-wheeler space this time. In terms of other way of looking at it, there's about close to 60% comes from non-Bajaj customers and about 40% comes from Bajaj. And EV-related orders constitute about 11% of the total. So let me stop with this, and then we are happy to take any questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashin from Equirus Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, sir, my first question is regarding the lighting business. So, the lighting industry is seeing good tailwinds which shift towards LED. So, could you please help us understand how much of the lighting industry is from India and how much from Europe? And what sort of growth do we see in this business, considering that the industry is growing pretty strongly over there? That's my first question.
Hi, this is Arjun. So I think in terms of product-wise or segmental revenues, we don't report. So I think lighting specifically, we don't report in terms of revenue. However, in general, right, I think as in India in particular, we keep moving towards LED. That generally implies significant content growth per vehicle, and that is very much a story that we're a part of. We've been a part of in 2016, and we continue to be a part of even today, whether in two-wheeler, whether in passenger car.
Sure. Sir, and my second question is regarding this. So EV now contributes approximately 4% of our revenue. So was it this bump up was majorly because of pre-buying in EVs, and what sort of a revenue from EVs do we expect going ahead?
So here, like we said in the last quarter also, that we are expecting revenues to be 1,000 crores in FY25. And, and we do see the momentum going up, going forward. We know that this FAME 2 subsidies have gone down, in June announced by the government. But I think a lot of the OEMs are actually innovating. The lithium prices have also gone down. So we do feel that the volumes will return. And we are also winning for the businesses, whether it's for the EV powertrain or otherwise for the EV programs, whether it's two-wheeler, four-wheeler. So we are quite confident that we'll achieve 1,000 crore revenue out of the EV business in FY25.
Sure. Thanks. I'll join back again.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for opportunity and congrats for the recent set of numbers. Sir, in four-wheeler business, we have seen a sharp growth quarter and quarter.
Sorry to interrupt, Mr. Abhishek, we are unable to hear you clearly.
Are you able to hear me now?
Much better, thank you.
So, in a four-wheeler business, we have seen a very sharp growth quarter and quarter. Is it because of the revenue growth in the lighting business?
Can you repeat it? You're saying on the four-wheeler side, we have seen a growth in our business?
Yes, sir. In quarter we have seen a very impressive growth. Is it because of the revenue growth in the lighting business?
So, year on year or a Q4 over Q1 you are saying?
Q4 over Q1.
Q4 over Q1 is mainly because of our BD2 operations overseas, where generally it's a calendar year. So January, February, March is little dull and then it picks up. And so our Romania business has done better as compared to the previous quarter. So that's why. Also market also.
Hello?
Yeah, so it's mainly the Romania business in our overseas operation, which is mainly supplying to four-wheeler.
Okay.
That has grown.
So in a lighting business, how much contribution from the domestic versus export now? Domestic versus overseas?
That's what Arjun said, that further split on the domestic and overseas, we would not like to comment at this moment of time.
So you have most of the business from the two-wheelers in the domestic side, or you are winning the new business in the four-wheeler as well?
So over the course of the last financial year, I think we won businesses in both two-wheeler and four-wheeler. And I would say the split in revenue between two-wheeler and four-wheeler lighting is pretty even.
Okay. And in a polymer business, you are showing degrowth. How do you see business ahead?
Yeah, this is mainly driven by, in Q4 we had some tooling revenue and all, so that did not happen, or it came down actually in Q1. So that's the reason.
So is it because of the fall in the net ASP, fall in the this commodity prices?
That will have, that also will have some impact. The fall in the commodity prices will have some impact also.
And also, if you look at four-wheeler sales from Q4 to Q1 has fallen by -6%. So that has also resulted the polymer business not to grow in line with the industry, in line with other segment.
Okay. And sir, in electronics business, your growth is quite impressive, around 21% Y on Y. So just wanted to understand that what are the key triggers behind that, and how much the contribution from the instrument cluster and from this business?
Yeah, so in general, our electronics business, as we've talked about before, right, I think we've been very focused in two-wheeler in terms of driving a content growth strategy. So when I say content growth, really the product lines that have grown significantly for us would be, things like for IC engine, things like fuel injection, also more LED headlamps. That has done very well for us. Further, from an EV perspective also, I think we see significant growth in revenue versus the past period. So I would say, content growth in existing vehicles, and a lot of the launches that we have driven, starting to see some level of, a lot of the new product launches that we've had last year, starting to see some level of incremental sales, and also, EV volumes growing for us. Clusters, I would say, I don't think, of course, as part of content growth, clusters will also see some level, but really the more significant for us would be fuel injection and EV components.
Okay, sir. And in a electronic business, basically you are targeting around 1,000 crores kind of the revenue from EVs from FY25. So what would be the contribution from this motor and controller segment out of the 1,000 crores?
So motor and motor controller, I would say, are really primary products for us. But again, I think more than the numbers that we've already talked about, I don't think we are not providing any further breakup.
Okay. And my last question is on
the majority.
Okay. And then my last question is on the polymer business. You are showing metallic business. In metallic business, what is your revenue target for FY24? Given the pricing of metal is going down, and what is the current margin in this business?
No, we don't give those guidances by business, but yeah, in every business we are aiming for growth only. At the total company level, of course, we continue to aim for double-digit growth, but we don't give guidance for each segment separately.
So what would be the triggers for this double-digit growth in terms of the capacity addition or the product additions?
Yeah, basically about the content growth, like how we explained earlier, both in terms of electric vehicles and also in terms of the ICE products also.
Okay, sir. Thanks, sir. That's all from my side.
We have said that we are going to grow 8 to 10% more than the industry growth, and that's what we are trying to achieve, as we move forward. And largely because of the content growth strategy, which comes a lot out of the electronics side.
Okay, got it. Thank you, sir.
Thank you. The next question is from the line of Aditya Jawar. Please go ahead.
Yeah. Thank you for the opportunity. My first question is that, recently we have seen product launches by Bajaj, specifically Triumph and Hero's Harley. So if you could, give us some sense, are we present in these vehicles and what kind of content per vehicle, are there in these two models?
Yeah, so we're present on both models. I would say the content on Triumph would be quite significant. Content on Harley we have content on Harley, but it would not be as significant as the content that we would have on Triumph.
Yeah, Arjun, if you have a number in mind, like is it about 30-40K or something per vehicle?
30-40K, I think on an IC engine vehicle, I don't think anybody's content reaches that level. But really, in terms of technology components and lighting, we supply the lighting for Triumph. We also, of course, supply all the painted plastics, seats, and mirrors as well also. Right. So the content I think would be at approximately 8,000 rupees.
Sorry, how much?
Approximately 8,000.
Okay. That's helpful. Any, EV component order win you would like to highlight where we have entered a new OEM, whether incumbent or new age OEM?
So I'm going to give you the same answer I've been giving you for some time now, Aditya. But I can promise, I think soon you will hear more.
Okay, sure. Now, we have spoken about, double-digit margin, and, we have already, at about 10%. So how should we think about margin expansion from here, and what would be the levers of margin expansion?
Yeah, so like what we mentioned earlier, we don't give any guidance, so don't take this as a guidance. But we continue to aim for a double-digit EBITDA margin. Now, in terms of drivers, if you really see, obviously the operating leverage should actually help us to a large extent. Plus, there are also several cost reduction actions which we are targeting internally, both from sourcing point of view and also in terms of efficiencies point of view. So these things should actually drive us to go for higher levels of EBITDA margin in the coming quarters and maybe next year also.
Okay. Now, on China, what kind of timelines we should have in mind with regard to the transfer of ownership and any potential value unlocking that we can see? If you can give some sense on timelines.
Yeah, so it is difficult to put a timeline to it, but if you ask me, the arbitration process should come to a conclusion before end of this financial year. But separately, there is a settlement activity also which is parallelly progressing, but not at the estimated pace that we are expecting it to be at. So it's difficult to put a specific timeline, but we would say maybe before end of the financial year, we have some good clarity.
Okay. Now, final question, if you can give some, sense on what kind of capex and debt repayment we should have in mind for FY24.
Yeah. So first quarter we spent about 50 crores, so there could be maybe another 100 to 150 crore of capex in the remaining 3 quarters. So that's on capex. So debt repayment, I don't want to put a number to it, but then you had seen that about 50 crore repayment is what we did in Q1. So all our efforts are basically to maximize the cash generation and then repay as much debt as possible before end of the year. But let's not put a number to it now.
Okay, that's quite helpful. That's it from me. All the best.
Thank you.
Thank you. The next a reminder to the participants, anyone wishing to ask a question, may please press star in 1. The next question is from the line of Basudev Banerjee from ICICI Securities. Please go ahead.
Thanks. A couple of questions. One, if I look at for almost last 7 quarters, your other expenses are more or less flat at around 280 crores. And in the meanwhile, revenues have also recovered quite a lot, and that's how margin has moved up from the lows of 5% to now 9.5%. So,
sorry, can you please repeat it? It's not very clear.
Yeah, and just for last 7 quarters in your reported numbers, other expense line item has been centered around 280 crores, whereas revenue has moved up from 1,500 crores to 1,800 crores on a quarterly basis, and that has also helped the margin improve from 5% to 9.5%. And as you said, operating leverage, cost management initiatives, etc. So if you can highlight like how long the other expense line item can remain around this level, so that one can have some idea about incremental operating leverage benefits, because 7 quarters is not a small time span.
Yeah, see, other expenses is difficult to predict because, as you know, it comprises of both variable and fixed elements. So they behave differently based on the scale of operations. So it is difficult to estimate how exactly it will move. It's a combination of both.
And earlier, as said, that certain efforts which the company is taking to reduce the fixed cost or reduce the variable component, it takes time to get visibility on the other expenses. It will happen 2 quarters, 3 quarters down the line. So yes, the other expenses have reduced, but as a percentage to the top line, but the efforts are there to further reduce and improve the profitability, as Group CFO said earlier.
Sure. And second thing, if I missed out, sir, initially you said 13 million euro you got back from the escrow account. And also you said 50 crores of debt reduction. So was this 50 exclusive of that 13 million euro, or the debt reduction in next quarter will come because of that?
Yeah. So that money is yet to be considered because it happened only in July. So we are talking about the numbers as of June end. So that number is yet to be taken.
Understood. Thanks.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star in 1. The next question is from the line of Arvind Sharma from Citi. Please go ahead.
Yeah, hi, good evening, sir, and thank you for taking my question. Just wanted to understand the sale of the 4-wheeler global lighting business. Now, in this quarter, again, you've given some discontinued operation-related expenses. Now, since you got some money after the quarter ended, so in the second quarter, would we see some discontinued operation-related income coming in? Just wanted more clarification on the accounting part.
Yeah, so we don't expect any income or expense from discontinued side hereafter. So this particular adjustment which we took in Q1 was relating to some of those costs relating to some management separations relating to the erstwhile lighting business. Plus, earlier we took a conservative view of how much we could get out of this escrow. So compared to that, there was about close to 1 million of shortfall with this final settlement. So that impact has also been taken. So with this, as of now, we don't expect any further income or expense on account of discontinued operations in the coming quarters.
Sure, sir. So now that business is fully separated. Sir, if you, I know it's a question which will be repeated, but if you could just give us a sense, in a succinct sense of the total inflow that we've had after selling the business. How much has finally accrued to Varroc, including the initial cash payment and the escrow? What has been the total cash inflow, and what was the final equity value of the business?
Yeah, see, let's talk about the equity first. Initially, we estimated the equity to be at 69.5 million euro. So after the 15 million settlement which we did, it finally ended up at 54.5. So that is as far as the equity is concerned. Coming to the cash flow part of it, I think it has 2-3 different parts. I think we also need to see the cash which came in and which we used to repay the overseas debt at the time of the transaction. So that would be a larger number. But let's only talk about the equity part, which is now finally at 54.5.
Okay, and this includes the escrow which you've got now?
Correct.
Okay. Thank you. Thank you so much, sir. That's all from my side.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Nisar Gwakaria from NV Alpha Fund Management LLP. Please go ahead.
Sir, just a small question on the interest payment that we have. So we are paying about 50 crore rupees interest per quarter. When will this start? When will this start coming down?
Yeah. So I think like how we explained earlier, we are already seeing some kind of a reduction sequentially if you really see. This quarter, the interest burden was lower by about 3 to 3.5 crores compared to the previous quarter. Of course, the inflow from the final settlement should actually reduce the debt further in Q2 also. And as and when we generate cash from operations and free cash flow, once we get it, we continue to repay the debt. So it should continuously go down hereafter is the expectation that we have. But we don't give any guidance here, but that's what we are targeting.
Sir, what is the net debt that we have today on our balance sheet?
Like how I explained earlier in the call, 1,228 is the net debt as of today.
Right. So we are paying interest for a debt of almost 1,800 to 2,000 crores. Isn't it better to use the cash and pay off the debt and then get the interest cost down to 120 crores?
No, I don't understand this 1,800 number that you mentioned. But like what I said, we are anyway, that's what we are doing. As and when there is surplus cash, we are actually going and repaying the debt.
Okay, sir, I'm sorry, I'm going to repeat. Maybe it's a little naive on my part, but I'm just trying to understand that if the net debt is 1,200 crores today, then why is the interest cost 200 crores? Because the interest cost is not more than 10-11% anywhere.
Yeah, no, the average interest cost comes to only around 9 to 9.5%, but it also has the discounting charges. So we also do the discounting of the customer receivables. So those discounting charges are also part of the interest cost.
Okay, and what is the discounting charges that we have per annum or per quarter approximately?
I mean, we don't give that kind of breakup, but we can broadly work it out, right? So I mentioned the interest rate to you on the debt level, you know. So.
Okay. And these discounting charges will continue, or you will stop doing them as your balance sheet strengthens? Because it's an expensive charge, no, for us?
No, see, as it stands now, this is one of the cheapest modes of finance that we have.
Okay.
Because obviously the customers are all big OEMs.
Okay.
So that way the risk is less, so the bankers are also willing to give it at lower rates.
Okay.
So So if I have to take it out, this will be the last one that I would touch. My first preference would be to reduce the high cost debt.
Okay.
And towards the end, yes, we will stop this also.
Okay. I get it. Thank you so much, sir. All the best.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for opportunity again. Sir, in aftermarket business, we are seeing a strong traction. So if you can throw some more light on the product and the network expansion in last 6 months.
So you see, the aftermarket business, continues to grow for us. Largely, we are more on the two-wheeler products, and whether it's for domestic or it's for export. And we continue to kind of increase the number of retailers or distributors we have, on a quarterly basis, 6-monthly basis. So we do see a good double-digit growth year on year. We're expecting as we move forward. And aftermarket for us is a profitable business, and that's something we continue to do as we move forward. So it's more like a steady growth that we are achieving, in our aftermarket business, which today for us is maybe about 5-6% of our revenues.
And in aftermarket business, how much is from the OEM channel, sir?
The aftermarket is purely non-OEM channel.
The spare parts sales which we do to the OEMs is not included into aftermarket.
That is not the aftermarket, and that's more like the what you supply, for the spares OES market. So that we count as OE business. This is purely, through our retailers and distributors for in India and for exports. This is what we call our aftermarket business.
Okay. And sir, your current capacity utilization is, I think, 60-65%, and you are looking for another capex of around 200 crores. So is this capex for only for this EVs product expansion, or in other segment as well?
So here I would say that this is more towards our future products, because for a lot of the traditional products which we are doing, we are at 60-65%. So this is only for, more of the value-added products which we have, where we see a future where we don't have a certain level of capacity. Those are the places actually, which includes EV also. So those are the places where we are actually investing.
Tooling also.
And it includes also for tooling, So basically, it is only largely more where we don't have a capacity, and which is more on the future product side, including EV.
Okay. And sorry, non-Bajaj revenue remained flat quarter on quarter. What is the reason, and how would be the trend going ahead?
Sorry, I couldn't get your question. It's not very clear, the line.
Sir, revenue from the non-Bajaj remained flat quarter on quarter. So what is the reason, and how would be the trend going ahead?
So it's not that it remains flat. The growth in Bajaj has been higher than other customers, because the supply of EV component to Bajaj has been much higher in Q1 as compared to Q4. Other segment, other customer includes customers related to four-wheelers like Mahindra, and VECV, Renault, Nissan, and even Volkswagen, Skoda, and we know that passenger vehicle quarter on quarter has fallen by 6%. So that's because of that.
So 71%. Sorry to interrupt, Mr. Abhishek. May we request that you return to the question queue? There are participants waiting for their turn. Thank you. The next question is from the line of Prateek Poddar from Nippon EMC. Please go ahead.
Yeah, hi sir. Sir, I just wanted to ask if you could split your capacity utilization business-wise, business unit-wise.
See, we cannot. What we are saying is largely, you can say as a company, we are at between 60-65% of capacity utilization. That means we have a big upside. with the current capacity, maybe some small incremental investments. And today our focus is how to fill up these capacities. And we are getting some traction there also as we are in the last many months. So we are trying to do that, with various customers, whether largely more on the two-wheeler side, some four-wheeler also. So this is where, we have this kind of an upside available for us. So whatever we fill up, will be a big, obviously, a gain for us. But we cannot, singling out, separately will be difficult for us to share.
So if I may ask the other way, which segment would be the one where, because look, 60% would be a weighted average of all the four businesses.
Yes.
I'm just trying to understand, sir, where is the highest delta? In which business segment is the highest delta? That's my limited question.
So if I was to take that for a second, right? I think the way to really think about it is we supply almost 20 products into two-wheeler mobility, right? Two and three-wheeler mobility. The capacities that we would have built, over the years would have been for a certain level of industry volume. Now, of course, as we know, that level of industry volume has not appeared since maybe FY19. So, again, it's hard to, let's say, break it down specifically in terms of, which product, which particular business unit, because every business unit also has 7 products within, right? But 60 to 65% is a fair number where the investment level delta to productionize that capacity would not be significant, right? So, again, I know I'm not giving you a clear answer, but really what I'm trying to say is where the capacities are available is generally where the two-wheeler market is being, or the kinds of capacities that are required for a two-wheeler and three-wheeler.
Got it. So if the two-wheeler market, let's say, were to go to FY19 levels in the next couple of years, you have enough capacity to cater to that, right? That's a fair understanding.
Exactly.
Okay. Brilliant. The second question is just on, improving the EBITDA margins, which was one of the key focus areas. QOQ, we have seen some moderation in employee expenses as well as other operating expenses. And I remember last quarter, MK talking about H2 being a very strong year for you, H2 of this year being very strong, wherein we could see sharp deleveraging. So is it fair to say that, the path continues in terms of improvement of operational improvement, and in H2 is where we start seeing a material improvement?
Yeah, that's the plan as of now, but don't take it as a guidance. But yeah, that's what we are aiming for.
Got it. And last question, sir, if you can help me understand, look, on a YOY basis, when I see two-wheeler industry growth and your growth, there has been a decent outperformance in terms of content or industry growth. But when I see it sequentially, two-wheelers on a QOQ basis is up 12%, and we are up just 6%, at least on the overall revenue side. And what am I missing, sir? If you can just help me understand this, that would be really helpful.
See, largely, just to let you know that, we have seen a strong growth from a two-wheeler segment. Most of our customers have grown quite well at a decent double digit, But the problem has been more the commercial vehicle and passenger car where we have seen the degrowth. And that's on the average, it has only been 6.2 or 6.4% because of that reason. Because two-wheeler grew very well, also including EVs. But the same thing, did not happen, unfortunately, this quarter on the four-wheeler side, where we saw a very weak performance. Industry itself, overall, I would say.
Got it. Helpful. And lastly, when you start new orders worth 577 crores as called out in the presentation, is it fair to say that these orders would be margin accretive to you versus what the legacy orders are? And to that extent, mix will help you and we'll see gross margin expansion?
Yes, definitely.
Okay, great, sir. Thanks, and all the best.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star in 1. The next question is from the line of Dhiral Shah from Phillip Capital PCG. Please go ahead.
Yeah, good evening, sir. Thanks for the opportunity. Sir, as you said that you are looking to outperform the industry by almost 8 to 10%, and majority of that will be driven by the content per vehicle. So what kind of increase, you are looking in the content per vehicle over next 2 to 3 years?
Could not get a lot of static.
Sorry to interrupt. Mr. Dhiral Shah, there's a lot of disturbance from your line.
Am I audible now?
Sir, I'll request you to use a handset mode while speaking and not the speakerphone.
Am I audible?
Sir, there's a lot of disturbance from your line.
Ma'am, actually I'm out. But just wanted to know, ma'am, what kind of increase, we are looking in the content per vehicle over next 2 to 3 years?
Okay, so again, I'd break that down. I think the way to think about it is, right, we look at EV separately and we look at IC engine separately. EV, fundamentally the content that as Varroc, based on the product lines that we could expect to have would be, I think, around 30 to 35,000 rupees in the past. Right? So I think as EV grows, that is a content level that we can address in a vehicle. And of course, we look to drive business wins in different customers in line with that, right? But for example, again, on the Chetak, that would be the amount of content that we would have. On an IC engine, really the technologies that drive content growth would be fuel injection, LED lighting, potentially electronic switches, and digital clusters. So as that, as OEMs keep converting their two-wheeler vehicles, and I think, if you look at new launches that OEMs have made, almost all of them generally come with this type of content, right? So as they keep driving those vehicle launches, we expect our content to keep growing. Now, beyond the point, it is difficult for me to comment exactly when which OEM will look to convert which segment of vehicles into, let's say, LED, for example. But as that takes place in the industry, we will definitely be at the forefront of it. All that put together, I think the kind of content that the total addressable content that we could have on a two-wheeler would be, even let's say in mass volume segments, around 10,000 rupees.
So this 10,000 rupees, is it currently the content per vehicle?
No. The average content per vehicle we would have today would be significantly lower. We have
it will be around 6,000 to 7,000. With other customers, it's much lower.
And sir, EV, you talked about the content per vehicle is 35,000, if I'm not wrong?
Yep.
Yes.
Okay, and so what kind of increase we are looking in the EV particularly?
So today the EV market is, so we are very focused again on two-wheeler and three-wheeler because those are our core, that is our core market. Today EV two-wheelers are generally scooters, right? So that is definitely the segment of focus for us.
Okay. Thank you so much, sir.
The one other thing also that I will add from a content perspective is even for passenger car, right? We look to integrate our capabilities to drive more system level solutions. So, for example, on a VW Taigun today, that is a product built by both the tailgate is a product that is built by both our polymer and lighting business. Right, so we integrate the rear lamps into the tailgate and supply the entire module to to VW. Similar to that, we pursue further businesses also. So that is outside of two-wheeler and three-wheeler in other lever or in other, let's say, channel of content growth for us.
Okay, thank you so much for the explanation, sir.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. Participants in the conference, if you wish to ask a question, you may please press star and 1. The next question is on the line of Prateek Poddar from Nippon EMC. Please go ahead.
But just could you double-click on the kind of efficiency measures you are working at so as to improve our margins?
Let me answer this question. Of course, I don't want to give you any specific numbers here, but if you want to understand the areas we are looking at,
yes,
energy is one area where we are looking at. Currently, the sourcing that we make from renewable energy is very less, so that we are trying to improve. There are also areas like packing material, logistics, and of course the overall fixed cost itself is what we are actually looking at. We are looking at various opportunities to reduce it. So these are the main areas we are targeting.
And just on fixed costs, sir, possible to double-click and help us understand how you try to reduce fixed costs?
There are various areas. We are looking at every single line item, whether it is consultants or retainers or advisors, or there could be some opportunities to eliminate some non-discretionary elements or some discretionary elements. So we are looking at every single line item and trying to see what could be a zero-based kind of approach to the fixed cost here. And based on that, how much is the fat that we can actually cut. But this will take some time. It won't happen immediately.
Sure.
For the next 1 to 2 years, we are trying to actually reduce it as much as possible.
That would also mean that the break-even points reduce, right?
Right. That's the intention.
Okay. And what is the level of break-even point today, and where do you aspire it to be?
We can't reveal that, but I think we can work it out based on our annual report and financial.
I can work out the current, but the aspiration is what I was trying to.
Aspiration, again, I don't want to put a number, but we are aiming for significant reduction. But again, this won't happen in months' time.
Right.
For the next couple of years, we are aiming for a significant reduction in the break-even levels.
As we emphasized in previous call, we have said that the first target remains to improve the PBT margin to 5%. Last year we did 1.7%, so our endeavor remains to go to 5% in the next 1 to 2 years, and then to higher single digit.
Super. Thank you so much, sir. Super. Best wishes for the future.
Thank you. The next question is on the line of Aditya Jawar. Please go ahead.
Yeah, thanks for the opportunity again. I just had one question. So, post the sale of our global lighting business, how should we think about our aspirations in the four-wheeler lighting in India? Are we seeing engagement with customers on future product launches, or are you seeing that there is an engagement with OEMs which are not present in India? You are having a dialogue with them. How should we look at the space post PLS sale?
So, again, I think the divestment that we drove was we hived off the geographies of Europe and North America, and we retained India and China. Now, today in India, fortunately for us maybe, but I think in particular when it comes to technology of the future and largely LED, we have a significant amount of content that is already on the road, right? And I think customers really understand and appreciate that, right? So some of the products that we already have on the road would be, on the XUV700 we do all the lighting, on the 2 new Renault Nissan models that launched maybe a year and a half ago, we do all the lighting. All the Skoda VW, we do the tail lamps. So this is really already localized capability across, design, development, manufacturing, which, customers can see and appreciate. Even through the last year, right after it was clear that this divestment is going to take place, we've been able to continue to win programs. And further, from a technology perspective also, I think we're largely covered, and I think customers understand and appreciate that. So I don't really see any reason why we should not be able to, there is no reason why we will not be able to capitalize on, this early mover advantage that we have in the market already.
Okay. Fair enough. I think that's it from my side. All the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Tarang Jain for his closing comments.
Yes, thank you everyone for joining the call. In the end, I would say that we are cautiously optimistic about our business and are working to further improve performance. We are grateful for your unwavering support in the past and look forward for continued encouragement for an exciting journey ahead. Thank you.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Investec Capital Services, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.